0.04 here. We are at 0.012, so that's about a quadrupling just to get to the 2011 highs in silver relative to stocks. But you look at this chart and it will amaze you. Look where we are now and look where we were in 1980. We will get to this number. It's going to happen. And this tiny little thing here, this little bump, that's the silver rally. That's the current silver rally. It's nothing compared to what is coming. There is plenty of time to go. Plenty of, maybe not time, but plenty of space to go in terms of purchasing power of the monetary metals relative to stock portfolios.
I have zero investment in silver. And I have heard that when silver going to reach 100 to 125 in February, then sell it. And I know certainly that JP Morgan is sell silver. You know, if you have confidence in this crap, then rock and roll and hoochie coo and sell your silver. I'm not, and I don't care what it does in terms of dollars. I'd say the same thing about gold.
The silver to stocks ratio currently sits at a historic low of 0.012. Meaning the metal would need to quadruple to match its 2011 valuation against equities. However, long-term charts reveal that the current rally is merely a tiny bump compared to the massive 1980 peak, suggesting immense upside potential remains. While rumors circulate urging investors to sell if prices reach $100 or $125 by February, citing reported selling by major players like JP Morgan, proper accumulation strategies ignore these fiat-denominated targets. Rafi Farber, author of The Endgame Investor, and Lynette Zang, a fierce advocate for tangible assets, warn against exiting early based on paper market noise. They emphasize that the ultimate objective is to preserve purchasing power in a failing currency system, arguing that selling real metal for depreciating dollars is a fundamental error, regardless of the nominal price. Now we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
If we talk about silver, silver has broken out a little bit more than gold. Yes, that's true. And we are at the final resistance here of 2014. Actually, what I wanted to point out here in this chart that I forgot is that the level that we are at in gold relative to stocks is still very close to the 2015 bear market bottom in gold. In dollar terms is 1045 right here, right where I'm circling, right below this circle over here, this red circle. We're very close to that number. So gold hasn't really moved much at all relative to stocks. Not at all. Plenty of time left. If we go to silver now, see it's moved a little bit more, but we're still at 2014 levels, still pretty close to 2015 levels, not as close as we are than gold, but we still have a long way to go to get to the 2011 top of about 0.04 here. We are at 0.012, so that's about a quadrupling just to get to the 2011 highs in silver relative to stocks. But you look at this chart and it will amaze you. Look where we are now and look where we were in 1980. We will get to this number. It's going to happen. And this tiny little thing here, this little bump, that's the silver rally. That's the current silver rally. It's nothing compared to what is coming. There is plenty of time to go. Plenty of, maybe not time, but plenty of space to go in terms of purchasing power of the monetary metals relative to stock portfolio.
I have zero investment in silver. And I have heard that when silver going to reach 100 to 125 in February, then sell it. And I know certainly that JP Morgan is sell silver. You know, if you have confidence in this crap, then rock and roll and hoochie coo and sell your silver. I'm not, and I don't care what it does in terms of dollars. I'd say the same thing about gold. I don't care what it does in terms of dollars, because we all know this is what they're doing to the dollars. So why would you ever want to convert it back into those dollars unless you had to do it to convert it into an income producing asset? I think that is very short-sighted. I don't think most of Wall Street understands what money is, and certainly what this stuff is. And by the way, I will bring up the fact that there have been five gold, there have been a bunch of gold revaluations in the U.S. They did it in 33. They did it again in, I think, 40 or 41. They did it again in let's see, after that, and there have been 5 confiscations in gold, with the last one 1971, I was alive. And it's interesting that I didn't even really think about that because the spin was so good. Nixon closed the gold window. Well, nowhere in there is the term confiscation, but that's what he did to the rest of the countries of the world whose gold we had promised to deliver out to them when they sent in dollars. That is a confiscation. So, just accumulate it, and don't worry about what it does in terms of dollars. I don't. Then I'm just ready. And you also need food, water, energy, security, barterability, which for me is primarily silver, but anything physical is barter, and wealth preservation, which for me is primarily gold, but having community and people around you that love. There's all different kinds of wealth, more than just monetary wealth. Community brings all of that together. And of course, you need a place to make your last stand. So I don't want you to have such a narrow focus that you lose sight of all of the things that you need to be self-sufficient, independent, and therefore go through this reset reasonable way. Dare I say it, come out the other side better. What except for the public to finally have the wealth shift their way in these created crises that really are not necessary. When we were on the gold standard, we did not have booms and busts, just like you saw on that 15-to-1 steady ratio. We did not have booms and busts. We had ebb flow. But with the central bank, they're really working hard for us to think that they're independent when they really are not. I think I did a video on that. Because who creates that? Congress legalizes the central bank. So what? You don't think they're going to take their pound of flesh to give them all of this power to create money? Of course they are. So it's just kind of a joke, but they don't want it to be obvious. Very interesting what continues to happen with the central bank. I don't think they're as independent as they want you to think they are to begin with. And shortly, they will be, you better have your gold and silver. Don't sell it, because you won't know 1 second before you've lost all of accumulate. And it's still dirt cheap. Accumulate.
The current rally in silver is described as a tiny bump compared to the historic valuation potential seen in 1980. Despite breaking past some resistance, both gold and silver remain significantly undervalued relative to equities, with silver sitting at a ratio of 0.012, requiring a fourfold increase to match its 2011 highs. The analysis argues that selling hard assets for fiat currency based on short-term price targets is a fundamental error, as the dollar itself is being systematically debased. Historical precedent cites 5 instances of gold revaluation or confiscation in the U.S., including the 1971 suspension of convertibility, which effectively confiscated value from global partners. This cycle of debasement underscores the necessity of independence from the banking system. Accurate wealth preservation extends beyond metal to include food, water, energy, and community, creating a fortress of self-sufficiency against manufactured economic crises. Accumulate physical assets while they remain dirt cheap and avoid converting back into a dying currency. Let's get back to the interview.
You can certainly see pretty clearly that red line, that silver has moved exponentially faster than spot gold in this longer-term relative performance chart. And this is just another one, a shorter term, where you can see where that diversion really took place, right? So this is everything this is about, is giving you the tools to make educated choices. And if I don't think we've done. So we'll get that done. Just look for it tomorrow. It'll be less than a minute. It's not going to take very long. And this is the gold to silver ratio since the beginning of 2025. And you can see how that has gone down, right? From 105 in April of 2025. So testing that resistance level on the top to whatever it is right now. But I've also told you many times that we will see that ratio grow more narrow. And then once we go into hyperinflation, then it changes again and it'll grow wider. So I pulled up the data from Weimar Republic in Germany, and not because that's the worst case, but because it's the most well-known case. And this is the data that I pulled on what happened to spot silver during that period of time. So this is 1919 and 1923, and it went from about 150 marks to an ounce to, let's see, hundreds, thousands, millions, billions, a trillion marks per ounce of silver. So it definitely enabled you to continue to buy food and whatever else you needed on a day-to-day basis. And it's why I like silver for barterability. But here is what happened to gold during that same period of time, or the spot gold market. Same period of time. That started out at 110 marks per ounce of gold and went up to 10 trillion marks per ounce of gold. And by the way, guys, is this really gold and silver going up? Or is it the mark going down because of all of the money printing that the government did to pay for all of the spending that they weren't earning? It's the same thing today. And this is, for that period of time, the silver to gold ratio during the Weimar hyperinflation. And you can see that it definitely did go down, right? It was 15 to 1 in 1919, 11 to 1 after that. By 1921, it was 40 to 1, so it had gone up substantially. And here you go, just like what we're experiencing today, spot silver moved up faster than spot gold. Both of them were moving up, but spot silver moved up faster, took it down to the 25 to 1, and then it was off to the races at the end of this, and it ended up at 100 to 1. I can show you more examples, and if you want them, let me know. I can do a whole piece just on the silver gold ratio during hyperinflation, and if that's something that would be interesting to you, I could put that on my very long list of videos to create. But essentially, I wanted you to see where we are, because I never look at silver or gold as a trade. If you want to look at it short-term trade, there are much better vehicles than the physical markets. Really, don't do that with the phys, because there's timing, and then there's also the fees involved and all of that. There are cheaper ways if what you're interested in, or even partially, because it never has to be all or none, if you're looking to capture this. And now you know. I mean, go back. Oh, let's see. I don't think I can. I have to go back once. So this is kind of like a pain in the neck, but I'll do it quickly. I think it's the one. Yeah, this one. Okay. So if you're thinking about doing this as a trade, pay attention to, and you have the links to everything anyway, so you can actually even go onto long-term trends and pull this particular chart. See if it breaks below that 50 to 1. If it does, then it's more likely to go down. If you're thinking about this as a trade, then this chart is the one for you to pay attention.
Why it's not too late to acquire gold and silver. First of all, with gold, this is the gold to the S&P 500 ratio going back to 1920. Where are we now? How many ounces of gold does it take to buy one S&P 500 unit? We're about 1.54 right now, and this is a critical pivot point that goes back to all the way to 1929. This was the top of the bubble here in terms of the real purchasing power of stocks in 2000. Ever since then, we haven't gotten close to the value of stocks relative to gold. But the fact here, first of all, that we were on a pivot line, and when this pivot line was last broken to the downside, it was 1973, 1974, where we entered into the 1980 top here in gold relative to stocks at about 0.2 ounces or something like that. We are still at 1.54, so there's a long way to go here. But the point I really wanted to make here is that even though gold's at $4,600, we're still at the high in stocks relative to gold at the 1929 top, right before the the crash. That is how overvalued stocks were back then. They are still overvalued now at the same ratio of 1929 on the eve of the October 29th, 1929 crash. This zone is going to get broken. It's going to get broken hard, and we're going to head to the 1980 level here, which has been reached about 3 times, once in the mid-1940s during World War II, once in 1932 at the stock market bottom relative to the dollar, which was also relative to gold then because we were still on a gold standard, especially in 1932. This is going much lower. Gold is going much higher relative to stocks. It doesn't even matter if the dollar figure goes higher. What matters is that the mainstream stock investors start to understand that investing in stocks is not protecting them from what they call inflation, and they all flood into gold and silver at the same time. That is still ahead. Gold hasn't broken out yet. If you take that same chart and you flip it, flip the ratio, you can see here we are at the final resistance. It's a triple top here, and triple tops never hold. This will be broken higher, and once we do, we will be on the way to the 2011 top of about 1.7. I can't even see what that is around here, but when this breaks, you're going to start to see gold outperform stocks handily, and then the mainstream normies start to realize this, and then they will start stampeding because they don't care about the dollar figure. They care about their dollar figure relative to their stock portfolio. If their stock portfolio is doing fine and great, they don't care how much gold is in dollar terms, and they have a reason, and it makes sense. Gold really hasn't broken out yet, you know? Here, look, this chart is the same as this chart, except it's stretched out back to 1970. So if we go back here, we can see from 2011. Now you look at 2011 here, you can see this is that 2011 top here, but this is the 1980 top. There's a long way to go. It's just above 7. The 2011 top was about 1.7. We're going to get to 1980 levels here, and gold is going to blow everything away except for silver. You can see here that this is the gold rally relative to stocks in 2026. It looks pretty pathetic here on an arithmetic chart. We have a long way to go. It's not too late to get some gold and silver. Now,
historical data from the Weimar Republic provides a chilling roadmap for precious metals during a currency collapse, revealing that silver often outperforms gold in the initial stages of hyperinflation. During the German mark's destruction between 1919 and 1923, silver's value exploded from 150 marks to over 1 trillion, moving exponentially faster than gold and temporarily compressing the ratio to 25-1. This historic volatility underscores silver's critical role not just as a store of value, but as a transactional necessity for daily survival when paper money becomes worthless. The current market divergence, where silver lags behind gold, is viewed as a temporary anomaly that will likely snap back violently as confidence in the dollar evaporates. As the fiat system falters, the ratio is expected to narrow significantly, validating the strategy of accumulating physical silver for its barterability and survival utility, rather than trading it for fleeting paper profits. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.